good afternoon. I want to thank everybody for joining our webinar today, where we're going to discuss a little bit about the differences here between a self-directed 401k and a self-directed IRA. There are some key differences kind of when you talk about these types of accounts and really what a solo 401k offers you as opposed to an IRA in particular. So if you're a self-employed individual, if you own your own business, if you're looking at starting a new business and want to figure out a way to save more for your retirement, this webinar really is going to be for you in discussing the solo 401k and how it contrasts again with a self-directed IRA account. So as we go through the webinar today, if you're listening live and you have any questions, please type those questions into the chat box on your screen. I'll make sure that I will get to those questions as they come up, or if I'm going to discuss or answer that question, I might leave it for a little bit later in the presentation, but we'll certainly get to all questions. If you're listening to the recorded version of this webinar, when the question comes up, just jot it down. My contact information, my email and phone number will be on the last slide of the webinar for you to reach back out to me and get your particular question answered. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I'm a licensed attorney by degree. I do not do any legal work for Advanta clients, but I've been with the company now since February of 2006, over 10 years, helping people understand the process of investing retirement funds into alternative assets. And part of what we do a lot of times when counseling somebody who's looking to become a client is to find out where their funds are at or what types of accounts they're looking to start. So that's, again, what we're doing today in talking specifically about the solo 401k. Now, one thing we don't do at Advanta, this will be important with some of the things we talk about, is we don't give any legal, tax, or investment advice when it comes to the accounts that we administer. So we're going to talk today about a lot about solo 401ks and the types of individuals that would benefit. But to find out how much it would really benefit you, that's a discussion you need to have with your CPA or with your tax advisor to look over your individual situation, see if a solo 401k is right for you. And even beyond that, when we start talking about IRAs in general as well, and the investments that people look to make, and whether or not some investment is a legal investment or it's permissible under IRS rules, definitely talk with those individuals. And if you need referrals, we can certainly refer you to a CPA, to an attorney, somebody else who will be able to give you those answers that we are not permitted to give. Now, a quick background on Advanta IRA. We've been around since 2004. The only thing that we do at Advanta is administer self-directed retirement accounts, whether that's an IRA, Roth IRA, a SEP IRA, or again, as we'll focus on a little bit more so today, the solo 401ks as well. The only thing we do is we can only handle qualified money, so it's got to be retirement funds, and we do the investment administration and record keeping that goes along with using your retirement dollars to invest in alternative investments, whether it's a piece of real estate, whether you're investing in private notes, mortgages, private placements, a lot of different things you can do. We don't sell any products. We simply provide this service. And I think the one thing we do very well at Advanta is really giving our clients a very good customer service experience, whether they're somebody who is local to one of our offices in either Tampa or Atlanta, or even clients who are not close to one of those offices in a geographic capacity, still being able to work with somebody one-on-one at our company rather than being just a number or just having to call into an 800 number to get the next available representative. Now, in general, why do people choose to self-direct? For a lot of clients, it's getting more diversity within their retirement accounts. So if you have monies invested in mutual funds and stocks, putting your IRA and putting your old 401k funds into real estate and other types of assets just gives you more diversity. Put your eggs in a couple of different baskets, metaphorically. For other clients, it's being able really to choose an investment that they understand. If I am a real estate investor, or if I am specialized and have a special knowledge in hedge fund investment, I might rather have my IRA account invested in that type of vehicle that I understand, rather than placing that money with a financial advisor, with a brokerage firm, where the money really is invested, and I'm not quite sure what is going on. And by doing so, I might be able to earn either a better or a consistent rate of return that makes me feel more comfortable, and also investing in things that are tangible, a piece of real estate you can touch, physical gold and silver bullion and coins, just makes people feel safer as well with the investments in their retirement account. And certainly in this day and age, that is very important to a lot of people. Now, as far as what types of assets can you hold in a self-directed capacity, these are the types of assets most people are not familiar with. Again, in any IRA, you can hold mutual funds and stocks. It's self-directed IRA accounts where the investment options are much different. And you can hold certainly any type of real estate, whether you're investing in raw land, commercial property, rehabs, or flips. The property could be a single-family home, could be a condo, again, could be an office building. If it has a deed, your IRA can invest in it. So any type of real estate would qualify as an investment in your IRA. Now, there's certain things you cannot do with that property that is owned by your retirement account. We will talk about that in a little bit as far as what the restrictions are. But as far as a type of an investment, real estate, any type of real estate would qualify. We also see a number of paper assets, people investing in contracts, people investing in loans and in notes, where their IRA isn't buying an actual structure or a piece of land or a physical asset. It might be lending money to somebody else or doing a deal or a contract or an arrangement with somebody else, where the investment held by the retirement account then really isn't a piece of paper. Again, whether it's a mortgage loan, a tax lien, unsecured notes, options, etc. List kind of really goes on and on of the different things you can invest into. Kind of the last category, at least for the slides that we have in the presentation, really is a catch-all, just other alternatives. People investing their IRA into private LLCs, farm animals, private partnerships, movie projects, again, the precious metals, the physical gold and silver, foreign currency trading. Again, there's a lot of different things you can do in your IRA or in your 401k account. It's the IRS rules that really just limit you to a few things you can't do, and we will touch on that more in the second half of the presentation today. Now, as far as the types of accounts that can be self-directed, any IRA qualifies to be self-directed. So regardless of where you have your account, if it is an IRA, you can certainly move those funds into a self-directed account and open up your investment opportunities. So the traditional or Roth, a SEP or a simple, that money can be used to invest in something that you can control. Now, the one plan, again, we're going to focus a little bit more on today than we most typically do in our seminars is an individual 401k or an individual profit sharing plan, where if you're a sole proprietor or if you own your own business and meet certain qualifications, you can establish your own 401k plan. And we're going to go over the differences between a 401k and an IRA here in just a moment. But those types of accounts can be self-directed, as well as any former employer plans. So if you worked for a company, you had a old 401k, you worked for the local school board and had a 403b plan, or you worked for the federal government, had a TSP or thrift savings plan, those funds, once you leave your employer, can also be self-directed by simply rolling that money out of that plan and into an IRA. And we also offer education and health savings accounts as well. Now, the differences between a lot of the different of the retirement accounts are twofold. There's a difference in the tax treatment of a Roth IRA and all of the other accounts. But the biggest difference between all the accounts is how much you can contribute. There are different formulas involved. We are contributing to a SEP, or to a simple, or to a 401k. And again, this is where a CPA or a tax advisor really comes into play in helping you decide which of these accounts are best for you. If you own your own business, again, and have some employees or don't have any employees, you're a sole proprietor, the SEP, the simple, and the 401k offer you larger contribution limits than does a traditional or Roth IRA account. So there's different formulas involved, and they apply differently to different types of businesses as well. And hopefully that's what we're going to explore here in just a moment. And again, the ESA and health savings accounts also have their contribution limits. Now, the limits on this slide are for 2016, largely unchanged from 2015. The only amount that changed was the health savings account in going from 20 to 15 to 2016. The amount you can contribute on an annual basis to your retirement account does index every year for inflation, but sometimes there's a couple years where they remain the same before they do go back up. So, how much can I contribute? We're going to take a hypothetical situation. Again, for your personal situation, go talk to your advisor, but kind of just to give you an idea of what you can do with the different types of accounts here at Advanta and the ability of the contribution limits. If we have an individual under the age of 50 who has $100,000 of earnings, compensation that is subject to Social Security and FICA taxes, generally that's going to be W-2 or Schedule C income, here's what they'd be able to contribute to the different accounts. Okay, so again, the amount you can contribute to an IRA does have to be based on earned income. Again, income that is subject to Social Security, FICA, or self-employment taxes, rental income, dividends, Social Security income, that does not qualify I should say, as earned income to be used as an IRA or retirement plan contribution. It does have to be earned. So we have someone who has $100,000 of earnings in their own business. What could they contribute? Now, to a traditional or Roth IRA, their limits are simply $5,500 a year. Okay, with the traditional Roth, if you have at least $5,500 worth of income, you can make that contribution into that type of an account. But that is the limit. There is no lump funding, at least, of a traditional Roth IRA of any more than that amount. Now, with a SEP IRA, the formula allows you to contribute to a SEP up to 25% of your compensation or your earned income to a maximum of $53,000 a year. So if you only have $100,000 of income or of earned income, that 25% limit would be $25,000. So with a SEP, you can contribute any amount from $0 up to $25,000 based on this example. Now with a simple IRA, you can basically put in $15,500. Now a simple IRA, you can defer the first $12,500 of your salary. So you as the employee of your own business can defer the first $12,500 of your salary. As the employer, when you own your own business, you are the employee and the employer. The employer can also do a 3% match. So 3% of $100,000, an additional $3,000 match on top of the $12,500 of salary deferral. So a simple IRA, you can put in at most $15,500 based on our example. Now, a simple IRA might benefit someone who actually has employees. So stepping back to the SEP IRA, if you owned your own business and you had employees who qualified under the SEP, if you contribute 25% for yourself, you must also contribute 25% for all of your employees as well. With a simple IRA, you can make it required that in order for the company to do the 3% match, that the employee must defer some of their salary as well. And so the 3% match, obviously, much less than the 25% with a simple IRA. Now, in this example, this is an individual does not have any employees who would qualify. The last account they would be eligible for would be an individual 401k plan. An individual 401k works just like a traditional 401k that a lot of people are familiar with. The difference being, again, that as an individual K plan, you are both the employee and the employer. There are no other employees you have to think about or have to worry about when making contributions. With a 401k plan, you are allowed to defer the first $18,000 of your salary into that particular plan in a given year. If you're over 50, there is a catch-up contribution of an additional $6,000, but again, this example, the person is under 50. They could defer the first $18,000 of their salary and then also do a 25% match. They can do a profit-sharing match on top of that of up to 25%. So when you take the combined salary deferral and profit-sharing match, the 401k allows you to put in $43,000 a year rather than just the $25,000 illustrated by the SEP IRA. Additionally, when you're comparing Roth IRAs to a solo 401k, if you start a solo 401k, you have the ability to designate your salary deferral as a Roth contribution. Again, now Roth IRAs, or Roth accounts, I should say, for those of you on the call who are not familiar with Roth, the difference between a Roth account and any other type of retirement account is in the tax treatment. We'll talk about this in just a moment. But keep in mind that $18,000 within a 401k can be put into a Roth account as opposed to just the $5,500 within a Roth IRA. Now, just looking at a few of these accounts at a glance, traditional IRAs, probably the most common type of retirement account, at least in the form of an IRA that is out there. They've been around since 1975, and a lot of people end up starting a traditional IRA by rolling over money from an old 401k or an old employer plan. When you, again, have those 403bs, the 401ks, the 457 plans, those can simply be rolled into a traditional IRA without any tax consequence. So a lot of people, when you leave your employer, elect to move that money from the employer into a traditional IRA. Additionally, if you're contributing money, new money, into the traditional IRA on an annual basis, those contributions go in tax deferred as well. So you get a tax deduction. You put the $5,500 into a traditional IRA, you get a deduction on your current tax bill. Now, the money, though, within a traditional IRA will grow tax deferred. So as you invest and reinvest within that particular account, you don't pay any taxes. Tax deferral allows you to, basically to grow your funds that much more quickly because the money is compounding without having to pay taxes each step of the way. Again, that's a benefit of a traditional IRA, and a lot of them, again, start with rollovers from employer plans. Now, the Roth IRA, again, the big difference that the Roth has, again, mainly over the traditional IRAs and regular 401ks, is in the tax treatment. Now, we're talking about traditionals, Roths, 401ks. The investment options are the same. It's the tax treatment and the contribution limits that are what are different. So if you have a Roth IRA or looking to start a Roth IRA, it works very much the inverse of a traditional IRA. When you contribute money, when you contribute some of your earned income into a Roth IRA, you do not get a deduction on your tax return. Okay, so you don't get any benefit now to put the money into the Roth in the form of a tax deduction. So the money the IRS deems, the money going into a Roth, goes in post-tax. As that money grows within the Roth IRA, it is tax deferred like the traditional IRA, meaning, again, you're compounding your money more quickly by not paying taxes each step of the way when you're making investments. The best thing about a Roth IRA comes at the end. That when you begin withdrawing money from your Roth IRA, when you reach the age of 59 and a half, and you've had a Roth for at least 5 years, the distributions you take out of a Roth come out completely tax-free to you, not simply tax-deferred. So with a Roth IRA, you actually are growing your money on a tax-free basis within the account. So again, going back a couple of slides, talking about the amount you can contribute with a Roth IRA, again, is limited to $5,500. But if you own your own business and you can start a solo 401k, you can actually put away $18,000 a year tax-free going into that Roth 401k and really jump-starting how much money you're going to have when you get to retirement. Now, we did have a question pop up, and again, as we go through the webinar today, you have more questions. Please type them into the chat box. It really helps speed the conversation, and certainly your question is probably being asked by somebody else internally as well. Question came up, said a 401k is rolled into an IRA, has no tax consequences. That's correct. 401ks directly into a traditional IRA, there's zero tax consequence for making that rollover. Question said, I have a 401k Roth. It is my understanding that I can roll into a Roth IRA this year before I turn 70 with an RMD. Is that correct? Yes, if you close the 401k, the Roth portion of what you've contributed can also be rolled out into a Roth IRA account. Okay, the traditional portions of your 401k would go into a traditional IRA. The Roth portions go into a Roth IRA. And Roth IRAs do not have required minimum distributions, which is what you said with an RMD. Taxable accounts, the traditionals, the 401ks, SEPs, etc., because you haven't paid taxes on that money yet, the IRS does require you to start pulling a certain portion of those funds out when you reach retirement age at 70 and a half. But with a Roth IRA, because that money is tax-free, there is no mandatory withdrawals. Again, another big difference between the traditional and the Roth IRA. Now, one other thing to understand about a Roth IRA, again, there's going to be a difference here between the Roth IRA and a Roth 401k, is that with a Roth IRA, the IRS also prohibits you from making a contribution if your income falls outside of certain guidelines. So if your modified adjusted gross income is above $132,000 and you're a single individual, the IRS will not allow you to contribute directly to a Roth IRA account. If you're married filing jointly and your modified adjusted gross income is over $194,000, again, you cannot contribute directly to a Roth IRA. Again, the key thing, again, talk about that, is a Roth IRA. So the question, another question, Bob said, if I have a 401k, can I roll to a Roth IRA without penalty? I am thinking no. If you have money in a 401k that is pre-tax, again, kind of a regular 401k of pre-tax dollars, you can roll that money into a Roth IRA, but that is what the IRS considers to be you're doing is a conversion, which is taking pre-tax money in a regular account, moving it into the tax-free Roth. You have to pay the taxes the year that money is moved from the regular IRA, or in this case, regular 401k, into the Roth account. So there's no penalty, but it is income tax. There's kind of no distinction there. Sometimes the taxes sounds like a penalty, but a penalty can apply to distributions if you're under 59.5. But in this case, doing a conversion, it's simply going to be taxable to you. So again, Roth IRAs, your adjusted gross income can make it so that you cannot contribute to those types of accounts. So keep that in mind when we talk about Roth 401ks, and one of the big differences there, we'll illustrate that. Again, the other types of IRAs that we have, maybe not as common as a traditional Roth, are I would call kind of an employer-sponsored or employer-based account. Your SEP IRA, your Simple IRA, and the individual K plan, again, suited for individuals who own their own businesses and may perhaps or not having employees involved in the plans. Now, one of the huge differences between a SEP and a Simple and a 401k is an administrative cost. Now, if you own your own business and you have employees and you want to set up a 401k plan for that for your company, you can end up having to have certain discrimination testing done and other types of administrative things done by a third-party administrator that will cost you more, obviously, to have that 401k plan. With a SEP or a Simple, that type of testing is not required, so it can be less costly to administer from an employer standpoint. Now, with SEPs and Simples, there are certain people that you have to include if you own your own business. There's, for a SEP IRA, anyone who's worked for you at least 3 of the last 5 years must be included. Simple IRAs, I think it's 2 of the last 5 as well. So just keep that in mind if you have employees. Generally, a SEP and a Simple can allow for it, but you might have to follow certain rules with that. The individual 401k, the solo K that we offer at Advanta IRA, is an account where you can't have any employees. It has to be just you as a sole proprietor, but again, offering you a much larger contribution, and there's no discrimination testing necessary. If you own your own business and you don't have employees, there is no one to be discriminated against. You're making contributions for yourself. There's no other employees that are being affected by that. Therefore, it's a much less expensive way to have a 401k plan when you do own your own business and you don't have employees. Question again comes up, if I have a loan in a 401k, does that have to be paid off before moving to an IRA? If you have borrowed money from your 401k, which we'll talk about in just a moment as well, if you have borrowed money from a 401k and you want to roll it into an IRA, you either have to pay that loan off before rolling it to the IRA to avoid any tax penalties, or I should say any taxes in doing so. My understanding, if you were to do the rollover while the loan is still outstanding, I think the outstanding balance of the loan is deemed as a distribution and is taxable to you. Again, just something else to consider with that. Now again, in talking about SEPs, Simples, and 401ks, the types of people that would benefit, people who own their own business, self-employed, if you have a company that is owned by a husband and wife, or spouses of owners can qualify for these plans as well. Again, sole proprietors or businesses who have excludable employees. Now again, within these plans, you can exclude certain people who actually are working for you. Anyone who is under the age of 21 does not qualify to be included under a SEP, a Simple, or a 401k plan. If you do own your own business and you're thinking about an individual K, as long as somebody does not work more than 1,000 hours a year for you, they do not qualify for that 401k as well. So if you simply had somebody working 10 to 15 hours a week, doing some odd jobs, just helping you out, maybe administratively, they're not going to qualify for inclusion in an individual K plan. Now, you do have to be careful. Once an individual works that 1,000 hours a year, they would then qualify and have to be included in your 401k, and then you would have to have a third-party administrator come in and do the various testing. Again, individuals who've worked for less than 3 years for you, or with a STEP, or 2 years for a simple, also do not have to be included in these types of plans. But what makes the 401k and is so appealing to individuals? I think certainly for one, there's the higher funding limits. We saw from a few slides ago with the individual $100,000 worth of income, and you're thinking about the 3 different types of employer plans. The 401k simply gives you the largest possible amount a year that you can put into, defer into, and get in that 401k and have it start growing your retirement account. There's also no income restrictions. When we talked about the Roth IRA, and there's certain limitations on how much modified adjusted gross income you can have to contribute to a Roth, that income limitation does not exist within a solo 401k plan. So if you were earning $300,000 a year as a sole practitioner without employees, you can still defer $18,000 of your salary per year into a Roth 401k. You also have the ability to borrow from. It's one of the questions we just had asked in the webinar, that you can borrow from a 401k plan. A lot of people, again, who've been involved in 401ks generally know that they have that option to either borrow 50% of the account value or $50,000, whichever is less, as a tax-free loan. You actually take a loan from your 401k, make those payments back into the plan itself on a tax-free basis. And again, the individual K, because you don't have any qualifying employees, there is no testing required, and it's much more cost-effective to have that type of plan for yourself rather than worrying about having a 401k for your particular business and having employees. Now, the 401k plan options we have at Advanta really have 2 different options. If you own your own business and you want to get this started, one I would call kind of our full-service option. Now, with any 401k plan, you must have an IRS-approved plan document, which is basically a thick, document full of all the rules for the 401k plan, how the 401k plan is going to be run. But the IRS requires you to have this approved document. At Advanta, we have a document that's been approved by the IRS that we can basically allow you to use if you set up these types of accounts. Now, with our full-service option, we will not only provide you with the plan document, so you have that IRS-approved document should they ever audit you, but we will also do all the record-keeping functions as well. So you can make your contributions to the accounts with us, and when you make your purchases into real estate, into notes and things we talked about, we will handle all of that record-keeping function. So the account owner, the 401k owner, still will direct all the activity, but we will take in the money, receive the income, pay the bills, etc. on behalf of the 401k. Anyone who's familiar with our service as a self-directed IRA administrator, essentially we're doing the same thing, but just in addition, also providing you with the 401k plan document. Now, the second option we have at Advanta, I would say if you're looking at this option, you want to probably have a CPA or a tax advisor involved in helping you at least get set up and get started, and probably maintaining this plan as well throughout the balance of the time it's in existence. Under the Do Your Own plan, we will simply provide the account owner with the plan document itself. So we give you the plan to lease, the 401k plan document, and then you as a 401k plan owner, the account owner can actually just go to a bank, go to your local Wells Fargo, to your local Bank of America, open up a bank account in the name of your 401k plan, deposit all of your contributions into that account, and then make all the investments in and out of that particular account. We would not perform any record-keeping functions at Advanta. We would simply be leasing you the plan document, and you as the account owner would perform all of those record-keeping functions. So no money actually comes into an Advanta account. Again, because now you're kind of doing this on your own, we would suggest having a CPA, tax advisor, bookkeeper, somebody else helping you make sure that you're keeping track of all the contributions you're making and also keeping track of all the income and expenses going in and out as well. Question came up and said, what are the fees for a 401k to move to an existing plan? Um, Generally speaking, you'd have to talk, if you're moving from a 401k that you already have established elsewhere, you'd have to talk with them and see what closure fees. Usually there's no fees on our end to have any money transferred or rolled over into either a plan with us or even an IRA account with us as well. So again, the two plan options, either full service, we'll lease you the plan document and do all the record keeping, or if you feel comfortable enough doing it and enough expertise, simply we can provide the plan document, and then you do your own record keeping from there. Now, as far as the difference in cost between the two, for the leasing of a plan document, we charge $300 per year to lease our plan document. If you were to go to a CPA or someone else and have them draft you up your own plan document, probably going to pay a few $1,000s to have that done. We can simply lease the document to you at $300 a year. So under the do your own plan, that's the only cost involved. Under the full service option, it's a $300 a year, plus our record keeping fees of $295 a year potentially for an asset, and our other costs we have that are seen with our IRA companies or our IRA clients as well. Now another question came up, what about filing a 5500, which is something that's unique to 401ks. It does not happen with IRAs. Now with a 401k plan, you are required to file an annual tax return. It's called an IRS Form 5500. Now, if it's a one-person plan, again, this solo 401k that we're talking about here, you only have to file that 5500 once the account value of the 401k is greater than $250,000, or you terminate the plan. So if you start a 401k account and you never reach $250,000, you don't have to file a 5500 until the year you actually terminate the plan. We do not file the 5500. That is something you would have to talk to a CPA or someone else that's having somebody else help you get that prepared. Question said, is the do your own plan the same as a checkbook style plan? It is similar. If you were familiar with the checkbook IRA, which involves an IRA setting up an LLC that gives the IRA owner more control over the funds, it is similar to that regard, except with a 401k plan, the IRS rules are a little bit different, and they do allow you as the IRA, as basically the 401k plan trustee, to open up your own account, do your own record-keeping functions, and not have to set up that LLC. So it's kind of similar because you're handling that out. But again, the other thing that's key to remember, to have a solo 401k plan, you have to have a business sponsoring that plan. So if you're working for a company, maybe you have an IRA or 401k through that company, and you want to set up a 401k plan on the side, you have to have another business that actually is sponsoring that plan. It's not a matter of simply setting up the plan. You have to actually have another LLC or an S Corp or some business that you are operating that is sponsoring that 401k plan. Now, some of the similarities between an IRA and the solo 401k plan. Still getting tax deferred or possibly tax-free growth, whether you're using a Roth account or just regular funds. You still have to have earned income to contribute to either one of those. The investment restrictions that we'll talk about in a moment, the things that are prohibited under IRS rules, the things you cannot do, same rules generally apply to those types of plans. If you make investments within your IRA or within your 401k account, all of that income coming for that investment must go back into the plan, or whether it's to the IRA, whether it's to the 401k account. And any expenses related to those investments also have to be paid by the account as well. Now, with both IRAs and 401k plans, you can partner up with other individuals or other retirement plans. And generally speaking, distributions from either IRA, Roth IRA, or 401k are penalty-free after age 59 and a half. Now again, with regular IRAs and regular 401ks, there's no penalty for distributions over 59 and a half, but you do have to pay tax. It's a big difference between the Roth accounts and the regulars. Now, some of the key differences between an IRA and a 401k plan. With an IRA, you must have an approved IRA custodian, or I'm sorry, an approved IRS custodian between you and the plan. So with an IRA, a custodian may be a brokerage firm, maybe a bank, but you are not allowed to simply set up a bank account in the name of your IRA like you can do with the 401k. We just talked about the do your own plan. That's exactly what when we're talking about being your own custodian. If it's your own business and you set up your own 401k plan and you elect for a do your own option, you simply can be your own trustee and do your own record keeping and just open up a bank account in the name of the 401k, make your contributions in, and go forward from there. With an IRA, to have that same degree of control, you still have to have an IRA set up with an approved custodian or administrator such as Advanta, and then direct the investments from there. With an IRA, again, one of the big differences that most people recognize, having possibly been involved in a 401k with a former employer or current employer perhaps, is that you cannot borrow from an IRA, but you can borrow personal loans from 401k plans. Again, I mentioned earlier, you can borrow up to $50,000 or 50% of the account value, whichever is less. IRS rules prohibit you from borrowing from your IRA. Question is, Kevin, can you borrow the total amount of money in a 401k? When does it have to be paid back? Probably was asking that question right as I was typing that, as right as I was saying it. Again, the limits on borrowing are that you can borrow up to 50% of the account value or $50,000, whichever is less. And when you borrow from a 401k, generally speaking, it has to be paid back within 5 years. You have to make regular payments back into that 401k plan. Now, income on leveraged real estate. It's kind of a little bit slightly advanced topic. We talk about investing in real estate with retirement accounts, but if you are borrowing money to purchase property inside an IRA, so your IRA makes a down payment and gets non-recourse financing for the remaining portion of the purchase, some of you that have looked into that know that that can subject your IRA to a tax called unrelated business income tax, also referred to as unrelated debt finance income tax as well. Within a 401k, if you have a 401k plan instead, make the down payment and acquire a debt financing to purchase a particular piece of real estate, the 401k plan actually does not pay that tax. Again, a huge difference when you talk about leveraging between the individual K and the IRA. And we talked about earlier, the ability to make Roth contributions to a Roth IRA is limited by your adjusted gross income. Again, we talked about if you're a single individual and you make more than $132,000, you cannot contribute to the Roth IRA. With the Roth 401k, the ability to make those contributions is not affected at all by the adjusted gross income. Now, with an IRA, your contributions can be made regardless of whether or not you were involved in a 401k plan. So if you are working for another company and you're deferring a portion of your salary and the company is making a match, you still can contribute to a regular IRA account. Now, check with your CPA on whether or not you would get a deduction, a tax deduction for doing so, but you still have the ability to make that contribution. Now, if you had a side business, so you do have an LLC on the side that you do work in, you pay yourself a salary, and at the same time you are also employed by another company that offers you a 401k, you cannot do full contributions to both. Contributions made to one plan will reduce the amounts you can make to another employer's plan. With IRAs, one other difference when starting these types of accounts is that with an IRA, you can make a one-time contribution to the account of $5,500 and never make any other additional contributions. It doesn't raise any flags with the IRS that you never made any additional contribution to an IRA. However, if you are starting a 401k plan and you're starting this for your business and you're maybe rolling over some IRA funds into that business to help get it started or just to have cash in your 401k, the IRS does expect that you're going to make contributions, whether it's your salary deferral or profit sharing match, at some point and probably continue. Now, maybe not every year, but they do want to see some contributions continuing into that type of plan to really make it a legitimate 401k plan. We talked already about if you're using an IRA and you want to get greater control over your funds in the form of a checkbook control, it requires you with an IRA to set up either an LLC or a trust to get that control. But with a 401k, you can open up a checking account at your local bank, basically lease the 401k plan document from us, and simply set up the name of the account, and so you have direct control without using an LLC or a trust. Finally, the last difference we'll talk about before we kind of keep moving on, I'll get another question answered that popped up, is what happens if you engage in a prohibited transaction. And we'll talk about what's not allowed in just a moment. But with an IRA, if your IRA engages in a prohibited transaction, you maybe buy a prohibited investment, you have dealings with somebody who's considered disqualified, your IRA loses its tax-exempt status. So your IRA ceases to be an IRA and results in possible penalties and taxes that accrue to both you and your IRA, and it can result in the complete loss of your IRA account. With a 401k, the prohibited transactions simply start, if there is a prohibited transaction, simply starts with a 15% penalty. Now, certainly not something you want to incur, and we caution you and can give you some guidelines to follow to try to avoid prohibited transactions. But at least the penalty is much less severe if you inadvertently do something wrong. Question says, do 401k have to take RMDs at 70 and a half? The answer is yes. Any taxable account, 401ks, IRAs, SEP IRAs, do also have the required minimum distribution at age 70 and a half. You have to start taking money out of those accounts at that time. It's only the Roth accounts that are exempt from the requirement of taking a minimum distribution. So if you have money in an IRA or an old 401k and you want to move this money around and start self-directing it through the funds, what are your options? First is a transfer. A transfer is moving money from one IRA to another without the client handling the funds. So your Schwab IRA transfers cash to your Advanta IRA. This is a non-taxable, non-reportable event. You can do as many transfers as you'd like, back and forth between IRA custodians, as long as you never touch the fund. If you have money in an old employer plan, again, the 401ks, 403bs, thrift savings plans, etc., old pensions, you can roll those funds out of that plan into an IRA by doing a direct rollover. Again, the money doesn't touch your hands. It goes directly from your old employer plan into the new IRA at Advanta. This is also a non-taxable event to you because, again, you're not taking any possession of the fund. The last mechanism listed on this slide, the indirect rollover, it is permissible under the rules for you to take money from an IRA or from an employer's plan, put it in your own pocket as a distribution, and if within 60 calendar days of receipt of those funds you put them back into another IRA, you ultimately avoid any taxes. Now, this can only be done once per 12 months across all of your retirement accounts. And this does trigger tax reporting. You will get a 1099 for taking the distribution. When you put the funds back in, that custodian will issue a Form 5498. But we really caution people the best way to move funds either by transfer or direct rollover. Question came up, is there a form or process to borrow from your 401k? Yes, you simply, if you have a 401k now, you would contact your 401k administrator to see what they would require. If you have a solo 401k with us at Advanta, we have internal forms you would use as well, and simply submit to us telling, I want to take a loan from the 401k, and we'll help you go forward from there. So again, we talked about possible investments in any type of real estate can be made in an IRA, any type of these paper assets, the other LLCs, partnerships, etc., can all be held within an IRA. The only investments the IRS says you cannot make within a retirement account are you cannot purchase life insurance, and you cannot purchase collectibles. And collectibles would include your antiques, your alcohol, artwork, kind of collectible, the rare stamps and rare coins are prohibited as well. The gold and silver American Eagles are allowed as an exception to this rule. But these are the only two investments the IRS says you cannot make within a retirement account. But the other restriction the IRS places on retirement accounts are who your IRA or in this case a 401k plan can transact with. Okay, the disqualified persons for your retirement plan include you as the account owner, your spouse, your parents and grandparents, your kids and grandkids, as well as any spouses of those individuals, and then also any business or entity that is owned or controlled by one of the above. So if you own a piece of real estate personally, you cannot sell it to your IRA or to your 401k plan. If you buy a piece of property in your IRA or your 401k, you cannot lease it to any of these individuals as well. And any of these individuals cannot do any of the work. If you own a piece of real estate and you want to have the property fixed up, you want to have the property enhanced, your IRA or 401k has to pay somebody else to do that particular work. Cannot pay any of the people who are considered disqualified. Now, some examples of disqualified persons. Your IRA or 401k buys a piece of property from your son is not allowed. Again, I mentioned your IRA or 401k owns property, leasing it to your daughter. She's disqualified. That's prohibited. Your father's IRA or 401k plan lending money to you or your son, that's going to be prohibited. Your IRA owns property and you're hiring yourself or your son or his company to do the work, again, also that will be prohibited as well. Again, the one exemption when we talk the differences between IRAs and 401ks is that you can personally borrow from a 401k, you cannot borrow from an IRA. Now, some other things to just consider with prohibited transactions. You cannot, if you're dealing with brothers and sisters or other family members, you should be doing so at a minimum at a fair market value on a fair market value level. If I'm lending money from my IRA or my 401k plan to my sister, it should be what she would have to pay anybody else not related to her. Under the rules, brothers and sisters, aunts, uncles, nieces, and nephews are not technically disqualified, but if I'm lending money to my sister at less than market rate, I, as the IRA owner, am now receiving kind of an intangible benefit from it, and I, as a disqualified person, am not supposed to be benefiting from that transaction. You cannot use a middleman between your IRA or 401k and somebody who's disqualified. So simply placing somebody in between the, kind of an intermediary step, the IRS considers that to be prohibited as well. So if I cannot buy a piece of real estate, having my IRA or 401k plan buy it from me, I can't get around the rules by first selling it to a friend and then having my IRA or 401k buy it from them. Likewise, again, you cannot use your retirement plan asset for your own benefit or enjoyment. So if you were looking at buying a property on the beach or in the mountains, it has to be strictly for investment, that you're going to either rent the property, rehab it, hold it for long-term appreciation, whatever the case may be, but you personally cannot receive any benefit from it. Now we're going to go through just a case study to kind of illustrate a little bit of the differences, again, between a 401k and an IRA in acquiring property. The titling differences and the process is a little bit different on our end when you're working with Advanta to make that purchase. So in this example, we're going to have John has $130,000 in retirement funds, whether that's an IRA or a 401k. We'll illustrate the differences. Doesn't trust the stock market, which is something that's fairly common that a lot of our clients tell us when they're setting up their accounts, and wants to buy a piece of property. Finds a good deal. You can get a rental for about $100,000, put a little bit of work into it, and get about $1,500 a month back in rents each month into his IRA or 401k plan. Now, under either scenario, the first step for John is to open up his Advanta account. Get the IRA, get the 401k plan established, get funds rolled over or transferred in, or make his contributions into those plans to get that account funded. Once the account has been opened and funded, John would find the investment property. We would work with John to make sure the offer and the contract are put in the correct name of his retirement account. He would then have to approve all of the closing documents for us. Our job at Advanta will be to work with the title company, tell them exactly how to title the particular property, get on the contract, on the deed, on any other closing documents. John will have to review and approve all the paperwork for us before we will send any money out of his account. So again, if we are holding all of the cash, we are not going to release any funds for the closing until John has actually looked over all the documents and approved them for us. So John will have to initial off on the deed, initial off on the HUD statement, initial off on the contract in order to begin that process. Now with IRA accounts, if John is buying this property using an IRA, he's going to approve the documents for us. We are then going to sign the contract, sign all the closing documents on behalf of the IRA, and then again ultimately send the funds from the account. If John is investing through a 401k or even a solo 401k, John will actually sign the documents as trustee of his 401k plan. It's getting a little bit different. He'll still have to sign and approve documents for us to release the cash, but as far as the execution, John will actually sign on behalf of his own plan. Again, the big difference when we do IRAs versus 401ks and buying real estate is in the titling. If John was buying this property in the name of his IRA, the contract and all the closing documents should reflect the owner as Advanta IRA for benefit of John Smith's IRA and then his account number. Okay, it's showing our company for the benefit of and holding title for the benefit of his particular IRA, and that is why we then in turn sign on behalf of the account. But if John is buying this property through his 401k plan, the wording would actually reflect as John Smith buying the property as trustee for the ABC 401k plan for the benefit of John Smith as participants. A little bit longer wording, a little bit different, but that is the proper wording to use to buy the property in the 401k. The 401k plan trustee actually takes title, and that in turn again is why John will sign the documents on behalf of his 401k plan. And this wording, again, must show up on all the closing documents, and if there are any other partners involved, the IRA or 401k would only own a percentage, and that percentage would also have to be reflected on the documents as well. Now, after the property is closed, the property has been purchased, the title company has closed the file, the IRA or 401k plan now owns the deed and owns the property. Going forward, all expenses, the repairs, maintenance, taxes, insurance, etc., must be paid by the retirement plan. Now, if Advanta is doing all of the record keeping, and in the case of an IRA, we're doing that record keeping regardless, if John is elected to have us also do the record keeping for his 401k, then John will simply send the bills directly to us to have them paid out of his account. So John sends us an email with the invoice, we get a check cut from his IRA or a check cut from his 401k to actually pay that bill. We typically get checks processed within 1 to 2 business days of receipt. If John did decide to do the do-your-own model, where he simply is leasing our plan document and setting up his own checking account at a local bank, when he has an expense, he'll simply write a check right out of that checking account. And again, he would want to make sure he's keeping track and keeping records of all that as well. Now, as expenses all have to be paid out of the IRA or 401k, all the income that is generated will flow back into the plan. And again, if Advanta is holding the cash and is doing the record keeping for that IRA or 401k, the tenant will simply send the rent check payable to his account, to John's account, and we'll deposit that back into his IRA or into his 401k plan. John could collect the checks if he wants to have his tenants mail the checks to him, but the funds must be directly deposited back into the Advanta account. John can track his accounts online or through our automatic email system. We give money come in or money leave your account at Advanta, you will receive an automatic email letting you know that has occurred. If John decided instead, again, to do your own model where he's leasing our plan document and getting a checking account, he can simply receive the rent check and deposit it right into that same checking account set up for the 401k. Again, the big difference with the do-your-own model and the regular traditional model, our full-service model, is in the record keeping. We are going to receive, with the full service, we receive all the rents, we pay all the bills for that 401k plan, probably categorize all those income and expenses. When it comes to the do-your-own model, John would actually be responsible for keeping track of that. And again, that's why John, if he's going to do a do-your-own model, we advise get a CPA, get a tax advisor, bookkeeper, someone involved to help you make sure that you're keeping proper track of that. Now, if you didn't have enough funds in your account to make a particular deal, what are some of your options? One, if you have partnering, you could partner up with somebody else. Somebody else has money in their IRA. They have money in their old 401k, or maybe they have money personally in a savings account. You could combine your IRA or your 401k with that other party and make the purchase, and then split the income and expenses proportionally between those two accounts. You could also make your annual contribution, and as we've seen with a 401k, you have a solo 401k, you have a lot of room to make a much larger contribution on an annual basis to bridge the gap and getting expenses paid or getting an asset purchased. The last option you might have would be to borrow funds in the form of a non-recourse loan, where your IRA, your 401k makes a down payment and then obtains a non-recourse loan for the balance of that purchase. Now, a non-recourse loan means that you cannot personally guarantee that loan. So the lender lends money to your IRA, to your 401k without the benefit of your signature on those documents. So you're not guaranteeing it. The only recourse the bank has would be to foreclose on the property if there's not any payment. So that's what a non-recourse loan means. They can't come after you personally if the loan isn't paid back. So a lot of lenders require much higher down payment in order to make that type of loan. So the loan is actually to the retirement account. The IRA receives income in, the IRA makes that, or 401k makes that loan payment out. Now again, with an IRA, if you were to put down 30% of a purchase price using your IRA and borrow 70% in the form of a non-recourse loan, that means 70% of the income you receive will be subject to this UDFI tax. So leveraged real estate in an IRA is subject to this tax. On the converse, if you had a 401k and you put down 30% of the purchase price in a 401k and it got a 70% loan for the remaining part of the purchase price, within a 401k you would not have to pay the UDFI tax, which can save you a huge amount of money and make that type of investment within the 401k as opposed to the IRA. That kind of getting started is fairly simple matter of filling out our paperwork to get an account opened. We have people at our office here who walk you right through every step of that process, then help you get the account funded by doing a transfer or rollover, then ultimately helping you make that particular investment as well. Some of our clients do come to us with an investment already in mind. We work the process a little bit differently. Now we have a client come up, or another question come up, and before we finish today, if you have any other questions, please get them in. Since I have an old 401k with my prior employer that's over $250,000 that I want to roll over into my solo 401k, but the old employer does not allow for partial distribution. What's the best way to get a portion of the funds into my solo 401k and keep it under $250,000? I think the option you would have with an old 401k is that you could move that entire account out into a traditional IRA. So you could move the money from the old 401k into a traditional IRA with a bank or a brokerage firm or with Advanta. Then when you open up the solo 401k, with an IRA, you can then just elect to transfer whatever amount less than the $250 into the solo 401k. That is another difference between IRAs and 401ks. With IRAs, partial transfers, partial distributions, etc. are fairly common. With 401ks, when you're no longer with that employer, some of them do insist that if you're going to move any portion of the money, that you take it all. And so in your option, to answer this question, you take this money, put it into a traditional IRA. Once it's in the traditional IRA, you have the option from there to carve it out in a couple different investments. Now, the only restriction you're going to have here is if you still wanted to be involved in your old 401k and have some money there, that's where you're probably not going to have that ability if they're not going to do a partial distribution. So I hope I answered that question there. Please contact me with anything additional. I can certainly help you get those questions answered also. Well, we're at the time to conclude the webinar, so here my information is here on this last slide. If anyone has any other questions, please give me a call, send me an email. I'm more than happy to always talk with you, answer any questions you have on that process, whether it's something we covered today, whether it's something we didn't cover today. Please reach out to us or visit us on the web at advantaira.com. Look for our upcoming events and seminars. If you connect with us on Facebook or on Twitter as well, you'll be notified of all those upcoming events and other great information as well. So again, thank you everybody for participating today, and I hope you have a great day.